Welcome back to the deep dive. Today, we're really getting into something quite technical, high stakes even, in the crypto trading world, arbitrage.
That's right. And our mission today, well, it's pretty straightforward. We want to pull out the essential knowledge, basically how traders try to squeeze profit from these tiny, almost invisible price gaps.
And often using Binance, right, given its size.
Exactly. Binance is huge, so it's often the main playground. We're aiming to give you, the listener, a solid structured picture of this advanced trading, the razor-thin margins, and honestly, why it's so vital for how Web3 actually functions.
You hear arbitrage, and maybe you think Wall Street, complex derivatives, that sort of thing. But the idea itself, it's simpler than that, isn't it? Pure economics at its core.
It really is. The beauty is its simplicity, fundamentally. It's just profiting from a temporary price difference for the exact same thing, like one Bitcoin or one ETH token, but across different markets.
So buy low here, sell high there simultaneously.
You nail the simultaneous buy in market A, where it's cheaper, and the simultaneous sell in market B, where it's a bit higher.
That word simultaneous feels like it's doing a lot of work there. Because if that timing slips...
The profit just evaporates, yeah.
Okay, but why Binance? I mean, there are hundreds of exchanges globally. What makes it the go-to hub for this kind of trading?
Look, it really boils down to two things: liquidity and connectivity. Scale and infrastructure, basically.
Right.
Arbitrage needs deep liquidity. That means Binance can soak up huge trades, the kind arbitragers need to make, without their own trade messing up the price. That's called slippage, and it kills profits.
Okay.
Plus, their global setup, their API connections. It's top-grade stuff. Professional traders need that institutional-level speed and reliability. If your whole game is speed, well, you need the fastest track, right?
Oh, makes sense. You need the best plumbing. So let's try and make this concrete for everyone listening. Have you ever noticed, maybe looking at prices that say Solana is just a few cents higher on one platform compared to another?
Yeah, exactly that.
That little gap, that's the window.
That's the window. That's the theoretical opportunity.
Right.
If you see SOL at $20 here, and you could instantly sell it for $20.05 over there, well, you've made 5 cents.
Okay, 5 cents. Doesn't sound like much.
It isn't per trade. But here's the catch. The market is packed with bots watching for exactly this. So that window, it might only be open for like a few hundred milliseconds, literally.
Wow.
So if you're a serious high-frequency trading outfit, you're hitting thousands of these trades, one after another, super fast. Because those 5-cent profits, they only add up if you're doing it with massive amounts of capital again and again.
Volume makes it worthwhile. So, okay, profits are tiny, maybe less than 0.1% sometimes. Why is this whole arbitrage thing considered so fundamental? Not just in crypto, but finance generally. What's the bigger picture beyond just the profit motive?
The bigger picture, it's market efficiency. That's the why. Arbitragers, whether they intend to or not, they act like this. This constant decentralized balancing force. Every time they make a successful trade, buying low, selling high, they're actually destroying the very price gap they exploited. They push the low price up a tiny bit and the high price down a tiny bit.
Ah, so they naturally pull prices together across different markets.
Exactly. They force the asset's price towards a single, unified value everywhere.
So the arbitrager is chasing profit for themselves, obviously, but the side effect is market health, cohesion.
Precisely.
Yeah.
If Bitcoin suddenly jumped 5% higher on one big exchange for some reason, arbitragers would flood in instantly, buying elsewhere, selling there, and boom, that price difference would get ironed out almost immediately.
So that drive for profit is actually what keeps the market stable and sort of honest.
It's arguably the most powerful stabilizing force we have in financial markets. Without arbitrage, imagine prices just drifting wildly apart on different exchanges. Market data would be a mess, trading would be chaos. This efficiency means that when you look up the price of Ethereum, you're generally seeing a price that reflects global supply and demand pretty consistently, no matter which major exchange you're checking.
And this whole activity, it doesn't just help prices stay aligned, it also attracts the big players, right? The institutional money.
Oh, absolutely. That's critical. Because the margins are so thin, like we said, you need huge amounts of capital ready to go, parked on multiple exchanges just to make it work.
Okay.
This need for instant execution, for handling big volumes, it attracts specialized financial firms, hedge funds, high-frequency trading desks, the serious players.
And their presence is good for the market overall.
Definitely. They bring deep liquidity. And deep liquidity is like the bedrock of a healthy market. It means one big trade, like a whale selling off, won't just crash the price because there are enough buyers and sellers ready to absorb that volume. Arbitrage activity helps ensure that depth.
Okay, fundamentals covered. Now, you mentioned it's not just one type of trade. Arbitrage is more like a category with different strategies depending on where you find the inefficiency. Let's break down the main types, especially those using Binance. What are they?
Yeah, we can sort of group them into four main buckets based on where the price difference is showing up. Is it between different exchanges? Is it inside one exchange across borders? Or between, say, the spot price and a futures contract?
Got it. Let's start with the one people probably picture first. Strategy A, spot arbitrage, the classic buying on one exchange, selling on another.
Yep, that's the most basic form. Spot arbitrage is buying the actual crypto, the spot asset where it's cheap,
Yeah.
and simultaneously selling it somewhere else where it's slightly more expensive.
And Binance often plays the role of the somewhere else because of its liquidity.
Often, yeah. It might be the destination where you sell because it can handle the volume, but the place you buy from could be a smaller regional exchange or maybe even an OTC desk over the counter.
Okay, sounds simple enough. Click buy here, click sell there. What makes this harder than it sounds? What are the logistical traps?
The big one is timing the actual movement of the crypto or the cash. See, if you buy Bitcoin on exchange A, then you have to wait, say, 10 or 15 minutes for the transaction to confirm on the blockchain before you can send it to exchange B to sell.
The price will have changed by then. Opportunity gone.
Almost certainly, yes. So the pros don't do it like that. They pre-position capital. They already have cash and crypto sitting on both exchanges. And so they can execute the buy on A and the sell on B truly simultaneously. Then, after the trade is locked in profit-wise, they worry about moving the underlying Bitcoin or fiat currency around later to rebalance their accounts for the next trade.
That makes sense. But even then,
You've got withdrawal limits on exchanges, transfer fees, network fees. All those little costs can just eat up that tiny sub 0.1% profit margin you were aiming for. It's very easy to end up losing money if you're not meticulous.
Right. Okay, that brings us to strategy B. You mentioned this one gets really interesting. Triangular arbitrage. This happens within a single exchange, like Binance, exploiting differences between three trading pairs.
Yes, this one is fascinating because it's purely about internal inefficiency. It's a math problem, basically. Exploiting tiny, momentary mispricings between three different assets, all on the same exchange.
How does that even happen?
It requires extreme speed technologically.
Well,
Because you're not fighting transfer times between exchanges. You're racing against Binance's own internal systems that are constantly trying to keep all the pairs aligned. An algorithm spots a split-second calculation error before the exchange itself corrects it.
Okay, walk us through an example. Let's use the $1,000 idea, maybe with BTC, ETH, and USDT, but keep the profit margin realistic.
Definitely realistic. So, okay, you start with $1,000 USDT. Step one. You instantly use that $1,000 USDT to buy Bitcoin.
Yeah.
You're trading on the BTC USDT pair.
Got it.
Step two. Immediately, like microseconds later, you take the Bitcoin you just bought and use it to buy Ethereum. Now you're using the ETH-BTC pair.
Okay, second leg.
Step three. And again, instantly, you take the Ethereum you now have and sell it straight back into USDT using the ETH as DT.
Completing the triangle.
Exactly. Now, if, for a fraction of a second, those three exchange rates were slightly out of whack, maybe because of a huge trade in one pair, or just tiny lag, you might end the loop not with $1,000 USDT, but maybe $1,000.50 USDT.
50 cents profit on $1,000? Okay. That's a 0.05% gain. That feels much more grounded than the maybe 1% examples you sometimes hear.
Oh, absolutely. 0.005% is actually a pretty decent outcome in the high-frequency arbitrage world for one loop. It underscores the reality.
Again, to make real money from that.
The volume has to be immense. Staggering, really.
Yeah.
To clear, say, $10,000 profit in a day from 0.05% margins, your bots need to be executing trades worth over $20 million in total volume daily.
Wow.
Yeah. It means having proprietary algorithms constantly scanning hundreds of pairs on Binance, especially involving their own BNB token, ETH, major stablecoins, looking for these fleeting three-way imbalances and firing off the trades instantly.
Okay, moving on. Strategy C, cross-border arbitrage. This one uses Binance's global reach to profit from price differences between countries.
That's right. This strategy often relies less on pure technological speed and more on navigating real-world frictions, things like regulatory hurdles or banking system limitations in different countries.
So the price difference exists because it's actually hard to move money across borders to close the gap.
Precisely. Binance, being global, reflects these regional price differences. If it's difficult for traders to get money into or out of a certain country quickly and cheaply, a price premium or discount can persist there.
And this is where we sometimes see those really big percentage differences emerge, right? Which seems weird if markets are efficient.
It does seem counterintuitive,
Uh,
but yes, the classic example is the kimchi premium in South Korea, which we should definitely dig into later. These big premiums happen exactly because something, usually government rules or banking controls, stops the free flow of capital that would normally erase the difference. The arbitrage gap becomes an enforced barrier.
Only players who can figure out how to legally and logistically jump that barrier can capture the profit.
Exactly, it's a different kind of game.
And finally, strategy D futures, or perpetual arbitrage. This one sounds more complex, dealing with derivatives like the difference between the spot price and the futures price on Binance futures.
Yeah, this is often called basis trading. It's about capturing the spread, the difference between the current market price, spot, and the price of a futures contract, or, more commonly in crypto, a perpetual swap contract.
Okay, how does that work? Are you betting on the price going up or down?
Not really on the direction of the price itself, it's more subtle. You typically take opposing positions simultaneously. For example, you might go long on the spot market, actually buy Bitcoin, and at the same time go short on the Bitcoin perpetual contract, effectively selling a derivative that tracks Bitcoin.
So you're hedged. Buying spot, selling the future, cancels out the price movement risk.
Largely, yes. You're not betting on where the price goes, but rather that the difference between the spot price and the perpetual contract price, it's called the basis, will shrink or converge over time. Or, and this is often key, you're aiming to capture the funding rate.
Ah, the funding rate. Let's unpack that. That's a big deal in perpetual swaps, isn't it? How does it work and how do arbitrageurs use it?
It's crucial. The funding rate is basically a mechanism exchanges like Binance use to keep the price of the perpetual contract anchored closely to the actual spot price of the underlying asset.
How is it calculated?
It's based on the difference between where the perpetual contract is currently trading and the index price, which is usually an average spot price from several major exchanges. Now, if the perpetual contract is trading higher than the spot price, meaning people are paying a premium to be long via the derivative.
And the longs have to pay the shorts.
Exactly. If the perpetual is more expensive, trading at a premium, then traders who are long the contract have to periodically pay a funding fee to the traders who are short the contract. If the perpetual is cheaper, trading at a discount, the shorts pay the longs. This usually happens every 8 hours on Binance.
Okay, so how does the arbitrager play this?
They can set up what's called a cash and carry trade. If the funding rate is positive, meaning longs are paying shorts because the perpetual is trading at a premium, the arbitrator will buy the actual Bitcoin, the cash asset, and simultaneously sell short the perpetual contract.
So they are positioned to receive the funding payment.
Precisely. They lock in the current difference between spot and perpetuals, the basis, hoping it converges. But more importantly, they collect that funding rate from all the traders who are long, potentially every 8 hours, for as long as they hold the position and the rate stays positive.
So it's potentially a steady income stream, less dependent on catching those split-second price gaps.
That's the attraction, yes. It can be a lower volatility strategy. The main risk is basis risk. The spread between spot and perpetuals might widen instead of narrowing, or the funding rate could flip negative, and there's still transaction costs. But if the funding rate is high enough, holding in that position can generate a fairly stable return over days or weeks. That's very appealing to funds looking for yield without taking huge directional bets.
Okay, hearing about these strategies, especially things like triangular arbitrage or capturing funding rates, it can sound almost like printing money, right? Like 0.05% gains hundreds of times a day, or steady funding payments. It seems so appealing. But we need a serious reality check here. Why can't the average person just set up a basic bot and get rich doing this? What makes it so incredibly hard?
Yeah, that's the biggest myth, that arbitrage is low risk or free money. It might have low directional risk because you're hedged, but it has incredibly high operational risk and technological risk.
What do you mean by that?
I mean, this isn't a battle you win by being smart about market direction. It's a battle fought with technology, speed, and infrastructure. It's won in the data center, not by looking at charts on your laptop.
Okay, let's break down those risks. Risk 1, execution speed. We touched on milliseconds, but just how critical is that speed? Why is it so cutthroat?
Because the opportunity itself is like a ghost in the machine. It's a momentary flicker of imbalance. The faster you are, the better price you get, or indeed, whether you get the trade at all before it disappears.
So it's a race.
It's an absolute race. The second a profitable spread appears, sophisticated high-frequency trading firms, HFTs, with their super-fast bots, are already reacting. If a price gap exists for, say, 500 milliseconds, and your setup takes 250 milliseconds just to see it and react,
You're competing against firms that react in maybe 50 milliseconds.
go way less. We're
Yeah.
talking microseconds, even nanoseconds, billionths of a second difference between a home setup and a professional HFT operation. That speed difference is everything.
Which leads us straight into maybe the biggest hurdle. Risk 4, the institutional arms race. This isn't just having a faster computer, is it? It's a different league entirely.
Oh, completely. It's like bringing a Formula One car to a go-kart track. The institutions have advantages retail traders simply cannot match, primarily through massive infrastructure investment.
Like what specifically?
The biggest one is co-location.
Co-location, meaning
It means they pay huge amounts of money to physically place their own trading servers inside the same data centers where the exchange's matching engine is located. Like, literally in the same building, racks away from Binance's core systems.
Whoa, so their trade signals don't even have to travel over the public internet.
Exactly. Forget the delay of your home internet connection sending a signal across the country or ocean to the Binance server farm that's milliseconds of latency right there. Their signal travels maybe a few meters through dedicated high-speed fiber optic cables directly to the exchange's engine.
And that saves how much time?
It might save only microseconds per trade, but when you're firing off thousands or hundreds of thousands of trades a day, those microseconds add up to a colossal advantage. They see the price changes first, they get their orders in first, they capture the spread before a retail trader's price feed is even updated.
So that physical proximity, that co-location, essentially guarantees they win the speed race almost every time.
It creates a massive technological asymmetry.
Yeah.
It makes direct, high-frequency arbitrage basically unwinnable for individuals competing against these firms.
Okay, that's a huge barrier. Let's go back to risk 2. Fees and slippage. Even if you are fast enough, costs can kill you, right?
Yep.
Especially with those tiny margins.
Absolutely. This is the silent killer of arbitrage profits. Exchanges, including Binance, have tiered fee structures. Unless you're trading enormous volumes to qualify for the lowest VIPC tiers, the standard trading fees alone will likely eat up any potential arbitrage profit on most trades.
And slippage, remind us what that is again.
Slippage is when the price moves slightly against you during the execution of your trade, especially if it's a large order. Your order gets filled, but maybe not entirely at the price you clicked, because your own trade volume pushed the price a tiny bit.
And in something like triangular arbitrage, where you're doing 3 trades back to back.
Exactly. If you get hit with slippage on even one of those 3 legs, the entire profit for that cycle is likely gone. You could easily end up with a net loss just from tiny movements during execution.
So the pros need incredibly sophisticated ways to manage that too.
Oh yeah. They use complex order routing software that might split a large trade across multiple smaller orders or different order books simultaneously to minimize market impact, to minimize slippage, and their algorithms are constantly recalculating the break-even point based on real-time fees and liquidity. One wrong setting, one sudden drop in liquidity on an exchange, and your supposedly risk-free arbitrage trade turns into a gamble.
Okay, and the last one, risk 3. Logistical and regulatory hurdles. This sounds like it hits the cross-exchange and cross-border strategies hardest.
Definitely. If you're trying to arbitrage between, say, Binance and another exchange, just managing your funds is a major headache. You need significant balances of multiple cryptos and multiple fiat currencies, sitting on all the exchanges you want to trade between, ready for instant execution.
Because you can't wait for transfers.
Right. And then you have withdrawal limits, maybe temporary deposit or withdrawal freezes by an exchange during maintenance, or high volatility, network congestion, slowing down transfers when you do need to rebalance. All these things introduce huge time risks.
Yeah.
Your capital can get locked up just when you need it most.
And the regulatory side, especially for cross-border.
That's often where the biggest potential profits are, like the kimchi premium, but it's also the highest wall to climb. Different countries have different KYC MRO rules, different reporting requirements, different rules about how much money can even move in or out of their banking system.
So trying to move millions from, say, Korea back to Europe after a successful arbitrage trade isn't simple.
Far from it. You can run straight into strict capital controls. Navigating that requires complex legal structures, multiple international banking relationships, dedicated compliance teams. It's territory only large, globally structured financial institutions can really operate in effectively.
So it really feels like for an individual trader, trying to compete directly in most forms of pure arbitrage, especially the high-frequency types, is Well, probably a losing game. You're just going to lose out to fees, speed, and complexity.
For the most part, yes. It's a game where the returns are constantly being competed down towards zero, and the advantages heavily favor those with the deepest pockets for technology and infrastructure.
Okay, before we dive into our final section, looking at real-world examples like that kimchi premium and connecting all this to the wider world of DeFi, we just wanted to take a quick moment. If you're finding this deep dive valuable, if getting into these kinds of details is helpful for you, please consider taking a second to interact with the show, liking, dropping a comment below with your thoughts, maybe sharing it. It genuinely helps us out a ton with visibility, helps the algorithm know people are engaging.
Yeah, that support really is crucial. Let's just keep putting in the time and effort to research and break down these sometimes pretty complex crypto topics for you. We appreciate it.
We really do. Okay, let's get back into it. Case studies and the bigger picture. Right. Let's put strategy C, cross-border arbitrage, under the microscope. You mentioned the definitive example, the kimchi premium. Let's unpack that. This was that period, roughly 2017 to maybe early 2021, where Bitcoin consistently traded way higher in South Korea.
Monumentally higher, yeah. The kimchi premium was incredible. We saw periods where Bitcoin on Korean exchanges was trading at premiums of 10%, 15%, sometimes even over 20%. Compared to the global price you'd see on Binance or Coinbase.
20%? That's insane for the same asset. How could such a massive gap persist for so long? Why didn't arbitrage just wipe it out instantly?
It persisted because of one main thing: friction. Specifically severe enforced restrictions on capital movement. Meaning the South Korean government and banking system had really strict capital controls and anti-money laundering regulations in place. It made it incredibly difficult for foreign traders to bring money into Korea, to buy BTC low elsewhere and sell high there, and equally difficult for Korean traders or residents to get their money out of Korea to do the reverse.
So you couldn't easily send dollars or euros into Korea to sell Bitcoin, nor could you easily sell Bitcoin in Korea and send the Korean won profit back out.
Exactly. That friction created a kind of walled garden. There was huge domestic demand for Bitcoin in Korea, but they couldn't easily access the cheaper global supply. And international arbitrageurs couldn't easily access the high prices and get their profits out in a usable currency. The supply-demand imbalance was basically locked in place by regulation.
So the arbitrage opportunity only existed because the normal corrective mechanism, free capital flow, was blocked. Fascinating. How did the big players eventually figure out ways to capture some of that premium despite the hurdles?
It involved really complex strategies. They weren't just wiring money around. They used sophisticated, multi-country corporate structures, often leveraging licensed institutional channels that had some ability to move funds legally. And crucially, stablecoins became a key workaround.
Using something like USDT instead of fiat.
Yes, because stablecoins are generally easier to move globally than traditional currencies tied to national banking systems. So an institution might manage to sell Bitcoin for a premium in Korean won, then convert those won into USDT within Korea, or through affiliated entities, move the USDT out digitally, and then convert it back to dollars or euros elsewhere.
That sounds incredibly complicated.
It was. It required multiple banking relationships, deep legal understanding of regulations in several countries, and the scale to absorb the still significant costs and complexities involved in those conversions and transfers. But because the premium itself was so massive, 20%, there was still a substantial profit left over, even after all those hoops were jumped through.
Wow. That really highlights that sometimes the biggest arbitrage isn't just about millisecond speed, it's about solving these incredibly complex logistical or regulatory puzzles.
Absolutely. The kimchi premium is the perfect example of friction-based arbitrage. And the data backs this up too. If you look at liquidity using volume analysis,
What does that show?
you see a clear correlation. When liquidity for a specific asset or pair is thin, meaning not many buyers and sellers, shallow order books, arbitrage opportunities tend to be wider and last longer.
Makes sense. Less competition to close the gap.
Right. In contrast, for super high liquidity pairs like BTC USDT on Binance, the gaps are minuscule and disappear almost instantly because the competition is fierce. The regulatory friction around Korea effectively created a deep, long-lasting pocket of illiquidity between the global market and the Korean market.
Let's talk about the tools pros use to spot these things. You mentioned a price spread heat map earlier. How does something like that work? What does it show a trader?
A price spread heat map is basically a visualization tool. It tracks in real time the price difference, the spread for key assets like Bitcoin, Ether, maybe BNB, across multiple major exchanges simultaneously. Think Binance, Coinbase, Kraken, maybe some big Asian exchanges too.
And it uses colors.
Yeah, typically. It might show, say, green if exchange A is trading 0.2% higher than exchange B for Bitcoin, and red if it's trading at a discount. Maybe yellow for very small differences.
So traders can just glance at it and instantly see where the significant imbalances are.
Exactly. It helps them cut through the noise and spot systemic patterns. Is one exchange consistently lagging behind others? Is a premium developing on a particular platform, perhaps due to specific news or regional activity? It lets them see the market's microstructure in action and potentially position their capital before a major divergence occurs based on those patterns. It's a vital tool for visualizing these tiny, fleeting opportunities across the whole market.
Okay, final pivot. Let's connect all this back to the broader world of Web3 and DeFi. If the whole point of DeFi is moving away from centralized giants like Binance, how do these same arbitrage principles still apply or even dominate in that decentralized ecosystem?
Well, what's really interesting is that arbitrage is fundamentally agnostic about the venue. The economic principle doesn't care if it's a centralized order book or a decentralized liquidity pool.
So as long as the same token can be bought and sold in two different places.
The incentive for arbitrage exists. And in DeFi, you don't just have two places, you have thousands of different protocols, automated market makers or AMMs like Uniswap, SushiSwap, Curve, Balancer, all trading the same tokens.
So if the price of, say, Chainlink is slightly different in a Uniswap pool versus a Curve pool.
That's a price gap. That's an arbitrage opportunity. And just like HFT bots police the prices between Binance and Coinbase, other bots, often called arbitrage bots or MEV bots, are constantly scanning the blockchain to find and exploit these price differences between DX pools.
So decentralized arbitrage keeps prices roughly in sync across the whole DeFi landscape.
Precisely. It's absolutely essential for DeFi's functioning. And this brings us to the concept of MEV, maximal extractable value.
Right. We've touched on MEV before. How does it specifically relate to this decentralized arbitrage? Who are the players involved on-chain?
Okay, so MEV strategies are kind of the DeFi equivalent of HFT on centralized exchanges. You have specialized actors called searchers. Yeah. Their job is to constantly monitor the mempool. That's like the public waiting room for transactions that have been submitted to a blockchain network like Ethereum, but haven't yet been included in a block.
Okay, what are they looking for in there?
You're looking for pending user transactions, especially large trades on DXs. They analyze these pending trades to see if, once executed, that trade will knock the price in a specific DX pool out of line with other pools, creating a temporary arbitrage opportunity.
So they see a big swap coming that will create an imbalance, and they try to jump in front of it or right after it.
Exactly. The searcher spots the potential arbitrage that the user's trade will create.
Yeah.
They then quickly construct their own sequence of transactions, maybe buying on DXA where the price will drop and selling on DXB where it's still higher, and they bundle these transactions together.
And how do they ensure their arbitrage trade gets executed right when they need it to?
They submit their transaction bundle directly to entities called block builders or validators, and they attach an incredibly high transaction fee, a gas fee, or a direct bribe. They're essentially bidding in a super high-speed auction, paying a premium for their transactions to be ordered perfectly within the next block to capture that arbitrage profit the instant it appears.
Wow. So it's like a constant invisible auction happening for block space, driven by these arbitrage opportunities. The searcher pays a big chunk of their potential profit just to get priority.
That's the essence of MEV competition, especially arbitrage MEV. Searchers are competing ferociously against other searchers who likely spotted the same fleeting opportunity. The mempool becomes this automated high-stakes battleground.
And the result?
The successful searcher captures the arbitrage profit, minus their high gas fee. The block builder or validator earns that hefty fee. And, just like in centralized markets, the overall market becomes more efficient because the price imbalance gets corrected almost instantly. It just reinforces how fundamental that drive for arbitrage profit is. It's keeping both CeFi and DeFi markets stitched together and functioning.
So what does this all mean? I guess it means that this relentless chase for tiny profits, that 0.05% gain, is actually the invisible engine driving stability and price consistency, whether you're talking about a giant like Binance or the sprawling decentralized world of Web3. Arbitrage isn't just a strategy, it's almost like a law of market physics.
That's a great way to put it. It's the ultimate expression of pure economic incentive pushing markets towards efficiency, no matter what technology layer they're built on. #to outro.
So this deep dive has really taken us through the demanding high-tech world of crypto arbitrage. We went from the basics, why it matters for market efficiency, all the way to the sophisticated strategies and the intense competition.
Yeah, and hopefully for you, the listener, the key takeaways are clear. Remember those four main strategy types. The basic spot arbitrage between exchanges, the complex internal triangular arbitrage, cross-border, which is often about navigating friction like that Kimchi premium, and futures perpetual arbitrage, playing the basis or the funding rates.
But just as importantly, we balance that with the harsh realities, the risks, that need for almost impossible speed.
Nanosecond speed, yeah,
How easily tiny fees and slippage can erase profits.
definitely.
The logistical nightmares of moving capital around.
Mm-hmm.
And ultimately, that overwhelming technological edge held by the big institutional players with colocation and the specialized MEV searchers in DeFi.
Right. Understanding those pressures, those hurdles, hopefully gives you a much better lens for analyzing why markets move the way they do, why prices converge so quickly, and maybe appreciating the forces at play behind the scenes.
Absolutely. So, before we wrap up, we want to leave you with a final thought, something to maybe chew on, building on everything we've discussed. Here it is. Given that institutional dominance in technology make direct arbitrage almost impossible for individuals now, and those profit margins are constantly being squeezed towards zero, what does that mean for the role of the informed, curious retail investor? How do you participate or navigate in a market increasingly defined by this high-speed, high-tech competition?
That's a really critical question for everyone in this space, I think. Something definitely worth pondering. Thank you for joining us on the deep dive.
We'll catch you on the next one.